Whenever a trader sits down with a small stake in his pocket and a big idea in his head, there's a certain electricity in the air. And today, as we talk about turning a humble thousands and thousands into something far larger through careful, disciplined pyramid trading, I can't help but think back to the previous video on the cost of ignoring risk management. Because without that foundation, no amount of tactical brilliance will keep you in the game. Now, let me speak to you the way I would have spoken to a young operator standing beside my desk in the old bucket shops. Pyramid trading isn't magic, and it isn't a shortcut. It's simply the art of pressing your advantage when the market finally decides you're right. And tell me, have you ever noticed how rare it is for the market to truly offer you that chance? That's why you don't waste it, not when you've spent hours reading the tape, studying the swings and waiting for your moment. Most traders rush in with both fists swinging, but that's not the Livermore way. I never made money by being reckless. I made money by being right and then being bolder when the market confirmed it. You start small, you let the trend prove itself, and only then, only when the market shows its hand, do you begin to build your position step by step. Does that sound slow to you? It should. Trading is the business of waiting, not lunging. When a man begins with a small account, like that 1K stake we're talking about, his greatest weapon isn't leverage or luck, it's patience. Most people misunderstand this. They think they need a windfall. What they really need is one good trend handled with the calm mind of a surgeon. You add to a winning position the way you'd add bricks to a wall. Carefully, only when the foundation beneath you is firm. Have you ever added too much too soon and felt the whole structure leaning over you? That's the market teaching you a lesson. But listen carefully. Pyramiding only works in markets that are moving cleanly in your favor. If you try stacking positions in a choppy mess, you're not pyramiding. You're just digging your own grave in slow motion. And you'd be surprised how many traders confuse motion with direction. They think a market that wiggles is a market that's trending. That's why reading the chart, truly reading it, like you'd read the tape in the old days, is the difference between a pyramid that reaches upward and one that collapses on your head. Tell me, do you take the time to study the structure of a trend, or do you just jump in because the price twitched? I've always believed that the market talks to those who listen long enough. Higher highs, higher lows, expanding volume, clean pullbacks. These are the signs of a trend worthy of building on. You don't pyramid because you want to. You pyramid because the market gives you permission. And permission in this business is earned through evidence, not hope. And here's something most traders never understand. A pyramid isn't a frenzy of buying. It's methodical. You let the market pay for your next unit. You raise your stop. You lock in the ground beneath your feet. Each new piece of the position stands on the shoulders of the previous ones. That way, if the market suddenly turns, you're not left exposed like a man walking a tightrope with no net. You're protected by structure, by discipline, by rules. Ask yourself, do you have rules you follow like a religion, or do you trade from the hip? Of course, you can't talk about this without talking about mindset. The average person thinks adding to a winner is dangerous and adding to a loser is averaging down. But that's backward thinking. Backward thinking has wiped out more traders than bad luck ever did. You must train your mind to welcome strength and avoid weakness. Most people buy weakness because it feels cheap. They sell strength because it feels expensive. But the market doesn't reward feelings. It rewards alignment, momentum, confirmation. Have you ever caught yourself doing the exact opposite of what the chart is telling you simply because your emotions whispered louder? And just as we discussed in the cost of ignoring risk management, none of this works if you refuse to guard your capital. A pyramid without stops is nothing but a tower built on sand. You size each addition with respect for the broader trend, and with even more respect for the possibility that you're wrong. I learned early in my career that being wrong isn't what hurts you, staying wrong is. That truth is as old as trading itself, yet traders ignore it every day like it's optional. Now, think about this, the goal isn't to force the 1K to become 100K. The goal is to execute the kind of disciplined trading that makes it possible over time. Markets offer opportunities in waves. Sometimes you'll pyramid 3 or 4 times on a beautiful trend. Other times you won't pyramid at all for weeks. But the trader who waits, who observes, who's willing to sit without trading, he's the one who catches the big swing when it comes. Do you let boredom push you into trades you shouldn't take, or can you wait like a hunter who knows the woods will eventually deliver? You must learn to see pyramiding not as aggression, but as participation in a trend that's already paying you. And just like we talked about before, risk, position sizing, discipline. These ideas aren't separate topics. They're spokes on the same wheel. Today's principle sits right on top of last video's lesson. A pyramid only works when you protect yourself on every step upward, treating each addition like fresh capital that demands its own risk guardrails. But don't misunderstand me. Pyramiding isn't something you attempt every chance you get. It's something you reserve for those rare moments when the market behaves like a runaway horse, and all you've got to do is hold the reins and stay in the saddle. You let the trend carry you, not the other way around. And as your account grows, not in leaps and bounds, but in deliberate, measured increments, you begin to understand what real trading feels like. It isn't frantic, it isn't shiny, it's steady, almost quiet, like water rising behind a dam. And the truth is, you'll never build anything meaningful in this business unless you learn to stay with your winners. Most traders can't. They get nervous. They cash out too soon. They think taking a quick profit is clever. But cleverness has never made a real operator wealthy. It's the big swing that makes the difference. The rare campaign where you scale into strength while everyone else waits for the pullback that never comes. Tell me honestly, have you ever looked back on a trade and realized the only thing missing was the courage to hold on? Because a pyramid, properly built, is nothing more than a trader trusting his read of the market and letting success compound, one careful layer at a time, while the trend still breathes in his favor. Adding to winning positions only when the market confirms strength is one of the most misunderstood principles in trading, yet it is the backbone of every successful pyramid strategy. Most traders think pyramiding simply means buying more because the price moved in their favor. But that's not the truth. Not the real operator's truth. Adding to a winner is not about excitement, momentum, or hope. It's about a confirmation structure and reading the market's behavior with a cold and detached mind. It's about recognizing that the market is validating your original judgment and only then deciding it's safe to press your advantage. If you've ever felt the tug of temptation to add to a position just because it's green, ask yourself honestly, did the market really confirm anything, or were you simply reacting emotionally to a small gain? Market confirmation is not a single candle or one strong push. It's a sequence of behaviors that tell you the trend has legs. That may show up as higher highs and higher lows, or clean breakouts followed by controlled pullbacks. It might appear as increasing volume as the trend pushes through key levels, or price-respecting moving averages that act like rails guiding the trend forward. The market speaks through these patterns, and when you learn to recognize them, you understand that confirmation is not a feeling, it's evidence. But have you ever mistaken excitement for evidence? Every trader has at some point, and that's why this principle matters. Adding to a winner requires timing, but not the frantic kind people imagine. You don't chase the move. You don't pile in after a breakout spike just because you fear missing out. You wait for the market to prove that the breakout is genuine. That usually means letting the price pull back, stabilize, and then continue moving in the direction of the trend. Only then do you allow your pyramid to grow one brick higher. When you add too early, without confirmation, you expose your account to unnecessary risk. A market can fake strength for a moment, but it cannot maintain false strength over a series of structured moves. That's why the patient trader builds slowly, while the impulsive trader builds all at once and pays the price. Another key part of confirmation is understanding the context. Sometimes the market is trending, but the trend is weak. Sometimes price moves up, but it's fighting through heavy overhead resistance. Sometimes the strength you see is nothing more than short covering, not real buying pressure. True confirmation comes when the trend behaves smoothly and naturally, not when it jerks its way upward with hesitation. Clean, decisive price action is the hallmark of real strength. If you've ever been tricked by a sharp move that collapsed the next day, you know exactly how dangerous false strength can be. That's why real operators wait. They want the market to reveal its character, not its mood. Adding to a winner also requires the trader to remain emotionally neutral. When your first position is in profit, the mind becomes excited. It wants to celebrate early. It wants to speed up the process. But adding to a position is not a celebration, it's a business decision. Your goal is not to inflate your ego by increasing size. It's to take advantage of a trend that is already paying you. This is where most traders fail. They add because they feel good, not because the market is strong. They add because they want to accelerate the win, not because the conditions justify it. How many times have you added to a profitable position only to watch the market turn the moment you sized up? Almost every trader knows that feeling, and it almost always comes from ignoring confirmation. Proper confirmation also protects you mentally. When you add based on real market strength, your confidence is grounded in analysis, not hope. You can manage the position with clarity instead of anxiety. But when you add too early or without confirmation, you instantly feel exposed. You tighten stops unnecessarily, you watch the screen more than you should, and you second-guess your entire plan. Poor additions create psychological pressure. Proper additions create psychological stability. If you've ever felt uneasy about a position you added to, chances are the market didn't actually confirm anything. You just wanted it to. There's another truth about confirmation that many traders overlook. It naturally limits how often you pyramid. The market doesn't offer real confirmation every day. Trends don't give clean, structured opportunities at every turn. That's why this principle acts as a filter. It keeps you from overtrading, from forcing pyramids where they don't belong. When you add only on genuine strength, you end up adding far less often. But the additions you do make are meaningful, powerful, and supported by the full weight of the trend. And isn't that the kind of trading most people wish they practiced? So when we say, add to winning positions only when the market confirms strength, we're really saying to respect the trend, respect the evidence, and respect the discipline that separates amateur moves from professional campaigns. Because strength isn't a moment, it's a pattern. And when the market shows you that pattern, that's when the real pyramid begins. Each pyramid layer must be financed by profit from the previous one. This single idea separates strategic pyramiding from reckless position stacking. Most traders misunderstand this entirely. They think pyramiding means throwing more money into a winning move simply because the price is going their way. But pyramiding, when done correctly, is a method of reducing risk while increasing exposure. It's a way of letting the market pay for your expansion instead of dipping further into your own capital. If you've ever wondered why some traders grow steadily while others burn out even with similar win rates, this principle is often the dividing line. When you allow profit from your first entry to fund your next addition, you shift the risk profile of the entire position. You're no longer trading with your initial capital. You're trading with earned ground. Imagine you start with 1 unit. The market moves cleanly in your favor, giving you enough unrealized profit to cover the cost of adding a second unit without increasing your net exposure. That means even if the market suddenly reverses, your loss is cushioned by the gains already built. It's like climbing a mountain with anchor points behind you. You advance, you secure, you advance again. Have you ever climbed without anchoring, only to slip and lose the whole gain? This concept protects traders from the emotional trap of overconfidence. When a position is profitable, the mind gets bold. It wants to double up, triple up, and make the most of the move. But disciplined pyramiding forces you to slow down. You don't add just because you're excited. You add because the math supports it. When the profit on the first unit equals or exceeds the risk of the second unit, That's when the market is essentially offering you a free attempt to increase your stake. The best traders wait for this moment instead of rushing ahead. If you think about your own trading, how many times have you increased size simply because your early profit made you feel invincible? Financing each layer from profits also imposes a natural limit on your aggression. If the trend isn't strong enough to generate the profits required for the next layer, that's your sign that the move may not be stable enough to build on. Weak trends can produce small gains, but they rarely produce the kind of pressure needed to justify stacking new units. So this rule acts not just as a money management principle, but as a trend quality filter. When the market isn't offering you enough cushion to support a second or third edition, it's telling you something about the reliability of the trend. Has the market ever whispered caution to you like that, and you ignored it? Another advantage of using profits to fund each new layer is psychological comfort. When you're adding with house money, your stress level remains low. Your stop loss can be adjusted upward, locking in profit as you build. Each new layer sits on a foundation of realized or protected gains. That structure gives you the confidence to hold through normal pullbacks, allowing your pyramid the breathing room it needs. Without that foundation, every pullback feels threatening. You end up watching every tick, tightening stops prematurely, or closing the position entirely out of fear. Many traders sabotage themselves this way, not because the market was against them, but because they built their position with too much of their own capital and not enough of the market's. Using profits to fund each addition also reinforces the mindset of trading from strength. When the market is rewarding your analysis, that's when you expand. When it isn't, you refrain. This mindset is the exact opposite of what many traders do. They add to losing trades hoping to average down, which is nothing more than digging a deeper hole. The real trader adds to strength, not weakness. And financing additions from profits ensures you never violate this rule without realizing it. It keeps your entire campaign oriented toward momentum, not struggle. Have you ever noticed that the worst losses often come from trying to rescue bad trades rather than enhancing good ones? There's a subtle but powerful elegance to this approach. Your position grows only when the market proves it deserves your increasing commitment. Each layer becomes a reward for being right, rather than a gamble that you hope pays off. It turns your trading into a series of logical steps instead of emotional leaps. And because you're treating your unrealized profits as strategic capital rather than imaginary wealth, you preserve your original account balance with remarkable consistency. Too many traders think profits are merely paper gains until they close the trade. But a professional treats unrealized profits as working capital that can be deployed under strict conditions. That shift in thinking alone can transform the way you trade. The beauty of pyramiding this way is that it naturally scales with the market's energy. When the trend is powerful, you accumulate layers quickly because profits arrive quickly. When the trend is sluggish, the spacing between layers widens. The method adapts itself automatically. It keeps you honest, keeps you patient, and keeps you aligned with the true flow of the market. The market becomes your guide instead of your opponent. You grow your position only when the market proves it can carry the weight of an additional layer. And every time you follow this rule, you reinforce the habits that protect traders from catastrophic overextension. So when you add only with profits, you transform pyramiding from a risky, aggressive tactic into a disciplined and controlled campaign, building your stake layer by layer with the market's cooperation rather than your own recklessness. And once you internalize this principle, your entire approach to building large positions begins to shift. Profit compounding works only when discipline outruns emotion, and that single truth sits at the center of every trader's long-term success. You can have the best strategy in the world, the cleanest chart setups, and even a string of winning trades, but if your emotions, fear, greed, impatience, hesitation, are steering the wheel, the compounding process collapses before it even has a chance to begin. Most traders don't lose because the market is unfair. They lose because their emotions refuse to let their discipline operate freely. Have you ever watched a winning idea slip away? Not because it failed, but because you got nervous and acted too soon or too late. Profit compounding isn't just a mathematical concept. It's an emotional test. The moment a trade turns profitable, the mind starts whispering suggestions. It wants to protect that profit because it sees it as something fragile. It wants to lock it in before the market takes it back. But compounding requires letting winners breathe. It demands patience. It demands that you allow the trade to develop without clipping its wings every time it twitches. Most traders can't do that. Not because they don't understand compounding, but because emotion tells them the profit is in danger. Have you ever felt the tightness in your chest the moment your P&L turns green, as if holding the trade any longer is risking everything? Discipline steps in where emotion distorts the view. A disciplined trader doesn't see a small, unrealized profit as something precious. He sees it as the starting point of potential growth. He sees a trend in motion, not a dollar amount to be hoarded. That mental shift is everything. When your discipline outruns your emotion, you don't obsess over the temporary ups and downs. You focus on the structure of the trend, the logic behind your entry, and the clarity of your target. You understand that a strong move requires room to unfold. Emotion says, take the money, it might disappear. Discipline says, stick to your rules, the trend is young. Which one wins more often in your own trading? Compounding relies on consistency, not intensity. You don't need massive trades, you need repeated, properly managed trades that stack on one another. But consistency is a psychological battle. One undisciplined decision can interrupt the compounding process that took weeks or months to build. When you exit early out of fear, overtrade out of boredom, or size up too aggressively out of excitement, you break the continuity required for growth. Compounding doesn't happen in bursts, it happens in sequences. One disciplined decision reinforces the next, creating a chain reaction of growth. Emotion breaks the links. Have you ever looked back at a month and realized a single moment of emotional impulse erased 10 days of steady progress? Another aspect of compounding that demands discipline is handling drawdowns. Every trader faces losing streaks, but the disciplined trader keeps losses controlled, measured, and expected. Emotionally driven traders expand risk during winning streaks and panic during losing ones. That pattern destroys compounding because it destabilizes the base capital. To compound, you need a stable core to build from. If your emotional swings cause your position sizes to balloon and collapse unpredictably, there is no foundation for growth, just chaos disguised as ambition. You may have noticed this in yourself. Do your trade sizes fluctuate more with emotion than with logic? The mind often tricks traders into thinking discipline is restrictive. In reality, discipline creates freedom. When you trust your rules, your position sizing framework, your risk parameters, and your exit strategy, you free yourself from constant second guessing. That mental freedom allows compounding to work quietly in the background. Emotion, on the other hand, chains you to every tick of the chart, convincing you that danger exists where none is present. Emotional trading is exhausting. Disciplined trading is steady. Which one do you think provides the environment where compounding thrives? One of the most overlooked parts of compounding is letting the market do the heavy lifting. Discipline allows the market to work for you. Emotion tries to work against the market, pushing you to intervene too soon or at the wrong moment. When you're disciplined, your role becomes observing and adjusting, not forcing and interrupting. You let your system operate. You let your winners run. You let your losers cut themselves off early. Compounding is the result of letting systems work, not the result of constant involvement. But emotion hates stillness. It whispers doubts, invents threats, and demands action, even when action is destructive. How many times have you meddled with a perfectly good trade because you feared doing nothing? Discipline also shapes how you view profits themselves. To a disciplined trader, profit is a tool, a resource to build with. To an emotional trader, profit is a trophy, a reward to celebrate or protect. Tools allow growth, trophies sit still. When you treat profit as something functional rather than fragile, you're able to reallocate it, pyramid it, or let it ride according to your strategy. When you treat profit like a trophy, you cash it out too soon or hesitate to use it effectively. That mindset difference influences the trajectory of your entire trading journey. Which category do your profits usually fall into? Compounding rewards the trader who can remain neutral in the face of fluctuations. The market will never move in a straight line, even during the strongest trends. Small pullbacks, consolidations, and tests are part of the process. Emotion panics at each dip. Discipline sees structure. Emotion tries to protect short-term gain. Discipline aims for long-term growth. The greater your ability to remain calm during normal market behavior, the more effectively compounding can work over time. Many traders sabotage their best entries simply because they interpret every small retracement as a threat rather than a natural pause. Ultimately, compounding is not about intelligence or complex strategy. It's about consistency, patience, and adherence to rules, even when emotion begs you to break them. The trader whose discipline outruns his emotion is the one who allows compounding to shape his equity curve, gradually at first, then more noticeably as the structure builds. And when you truly understand that this dynamic, discipline over emotion, is the engine behind all sustainable trading growth, the way you approach every decision begins to change.